Okay, good afternoon, everyone. Welcome today to the PTG University Wednesday workshop educational series. And today we're going to discuss techniques in probability thinking. Now, this will be module 2 in our ongoing series, new development series here. So today's Wednesday, March 25th, 2015. And again, welcome here. So, thinking in probabilities as the subject, what is that? What does it mean? I write up here that it's the trader's edge. You can have methodology, you can have platform, which is your technology, you can have the fastest computer, you can have a great robust methodology. Your psychology is important as well. And you've heard many times that traders, professional traders, think in probabilities. And when they take trades, trades are uncertain, but they have certain potential for positive outcomes. And successful traders find out what works for them, and they exploit that edge. And so the trader's mind has to learn to think in probability. So how do we do that? Every trader's method of thinking in probabilities certainly is not the same, but they have very similar characteristics in how they go about doing it. So it's important, and it is very essential to one's consistent success. You have to have a thought process that is repeatable and in the face of uncertain conditions. So although the market is very volatile, we don't know what's going to actually happen next, and nor do we need to know what needs to happen next in order to make any money. We need to identify what the current conditions are, as we discuss on a day-to-day basis, such as today being a trend down. We need to understand where the energy of the market is, and we need to be in alignment with that. So trading and thinking in probabilities is not necessarily about a setup, but rather more of a mindset of a process of assessing the market's condition and taking advantage of it. Now, the big question is, how can a trader produce consistent results from an event that has uncertain probabilistic outcome? So if you take an individual trade, how do you know that that trade has a higher probability of success over another, where each trade is statistically independent of each other? So in order to get some understanding of the comparison here is we look to what the casinos do, and this is a bit of a paradox, and then that random outcomes of individual trades over a large set of trades or a sample size, if it has a positive expectancy, meaning that the expectation is a positive outcome rather than a negative outcome more often, it will produce consistent results. But each individual trade has a random outcome. It can win or it can lose. All right. So the casinos, they make profits, daily, and they facilitate an event that has a purely random outcome. And one of the examples we use a lot is blackjack. But most traders believe that the outcome of the market's behavior is not truly random. They think they can predict what the market is going to do, how far it's going to move, and to some degree they may have some success in that in the very short term, but over long term, you cannot really, predict the market's outcome that consistently. But they do believe that they can, and yet those particular ones that try to do that, they can't seem to produce consistent results. Or the results that they do produce are consistently negative. On the other hand, they don't understand that over a large series of trades, random outcomes can have a positive, consistent results. So here's the key: the casino gamblers, right, and best traders have an understanding, like the typical trader does not, that events have a probabilistic outcome can produce consistent results. They know that. But the only way to get that is to have odds in your favor, and you have to have a large enough sample size. So there's a lot of traders come in and they take 1 trade or 2 trade a day, 3 trade, and they lose on 2, and they maybe win on the next one, and the winner is much less than the first 2, and then they continue to beat themselves up. Yet then the next 2 or 3 opportunities that are presented to them, they don't take. Okay? Well, at the end of the day, the best traders, okay, it's a numbers game for them. They want as many possibility or opportunities to trade throughout the day as possible. Now, they're not looking to trade 10, 15, 20, 25 times, 100 times, whatever it may be. They're not necessarily looking for a specific number. They're looking for the opportunity to trade. They're like, give me opportunity, and I want to take that trade. Give me a valid opportunity, I want to take that trade. Okay? Very similar to our premium and discounts. Okay, we have a standard one, which occurs, over a fairly consistent pace. We also have turbos. The turbos give us many more opportunities. Okay, and in the right context, they actually provide some of the better opportunities that a standard wouldn't offer us, because the standard would have never given us a signal. So a professional trader wants as many opportunities as possible. All right. So there is a difference between how people successfully trade, all right, and how the approach that they use. So the professional gamblers approach is similar, very much like the casino. In other words, they take every trade, and that's something that we advocate quite a bit here. Is that you have to take every consistent trade. You may not, you may think that a trade may not work. So like there was one trade here at the end of the day. It was a turbo premium, and we were down, near the lows at the time, and we had some real nice trades throughout the day, but yet we weren't quite sure that was going to work. But it was a valid one nonetheless. All right, and if you took it, you probably made another 5 or 6 handles. Okay. If you didn't, because you weren't sure of them, you passed out of an opportunity. That's what we're saying, is that we have to simply take as many opportunities as possible, win, lose, or draw. Okay, and there are ways of doing that, of kind of helping us handicap which ones we want to take. So what we have to really do is develop a new belief, all right, that is contrary to our current thinking. So taking the example of blackjack, now I think these statistics are still valid here, is that the casino's edge in blackjack is only 4.5%. That may be slightly different. All right, I'm not sure. I'm pretty sure that it's fairly accurate, the statistics that I found on that. But here are the rules for the house, is that the house must play every hand, no exception. Okay? For each hand played, there will be an unequal distribution of winning and losing hands. Unequal. But on a collective basis, the opposite is true. if enough hands are played, patterns will emerge which ultimately produce consistent, predictable, and more importantly, statistically reliable outcomes. Okay? So for instance, if the blackjack dealer has a 17, okay, he has to hit on 17 every single time. You, as a discretionary player, do not. You can stand on 17 if you want. The house has to hit no matter what. So the outcomes are produced because the rules set forth to execute a hand played is the same over and over and over again. The trader's edge, of course, is his methodology, and the trader has to have rules as well. So very similar to the casino, the trader has to execute every single setup as defined by his methodology. Every single one, if it is a valid, verifiable trade. If it's verified, has to be traded. Win, lose, or draw. I speak about this quite often in our membership during the day. So the same applies here. For every trade, although there's a random outcome associated with that trade, every trade is statistically independent. All right? But over a large series of trades, all right, and there's an unequal distribution, so you can't think about it as, well, I'm going to take this trade only if it wins. Or I'm not going to take that trade because I don't think that is going to win. All right? How do you know that is not going to win? Okay? There are ways of handicapping better trade opportunities, and we discussed that, and we'll touch upon that later in the presentation here today. But keep one thing in mind: we have to play every trade opportunity given to us that is valid and verifiable. Okay? So again, on a collective basis, just the same is true in blackjack, same is true with the trader's methodology. If there is a positive edge or expectancy, okay, then the trader over time, over a large series of opportunities, you're going to produce statistically reliable positive outcomes. All right? It's mathematically impossible not to, providing that the methodology has a positive expectancy. And here at Polaris, our premium and discounts clearly do. All right? So that's what the casino owners and the gamblers understand about, the nature of probabilities that many uninformed traders don't. That simply each individual hand played is statistically independent of every other. Okay? It's like flipping a coin. Right? Every time you flip a coin, what are the odds of heads or tails? 50%. Okay? What are the odds? So I flip a coin, 15 times, 20 times, 100 times. What's the odds of heads over tails over the next flip? 50%. But after having a large series of trades or flips, okay, patterns will emerge. Okay, that's with a fair coin. All right, now if you have one that has a coin that has every time you hit heads, it'll pay you $2, and every time you hit tails, it'll pay you $1. Okay, so that's a 2-to-1 reward-risk ratio. All right, not a simple 1-to-1. So now you start flipping the coin, and again, what's the probability of getting heads versus tails? 50%. But over a large series of trades, each time heads comes up, you're going to get paid $2 versus $1. Everybody understand that? So each coin flip is a unique event, whereas the outcome of each individual trade, or each individual coin flip in this case, right, is statistically independent. All right, 50%, 50%, 50%. But if you have an edge on that coin flip, then you're going to keep flipping that coin, because every time you get heads, you're going to get $2. Every time you get tails, you're going to get $1. Okay, does everybody kind of follow along with that thinking? All right, so if you have a trade setup that is simple one-to-one reward risk, well, over a large series of trades, you're probably going to be breaking even. Okay, 50% back and forth. So you need an edge. You need a higher probability of one outcome occurring over another. Okay, and so our trade setups here, we have that. All right, and again, we demonstrate that on a day-to-day basis. But that said, the only way to exploit that is if the trader executes it flawlessly. Right? You know, part of our job as traders is to execute our methodology, not question the methodology, but execute it, and execute it flawlessly. Okay, now that doesn't mean perfectly, with perfection, but more flawless. In other words, you strive for, excellence rather than perfection. But it's important that you understand that you have to trade your methodology every opportunity. You can't sit there and say, well, I don't think this one's going to work, because you don't have an idea whether it will or it won't. So what we have to do is we have to develop a logical approach to thinking in probabilities. Okay? So garbage in, garbage out. The input-output loop. All right, everybody's heard that before, GIGO? Garbage in, garbage out. So as traders, throughout the course of the session, you guys may be watching CNBC, you're reading blog reports, you may be looking at stock twits, reading other Twitter posts, everything. There's just a bombardment of information out there. All right. What happens is if you focus on those media inputs, you're not really paying attention to what you should be as a trader, paying attention to what's in front of you on the screen. Now, what we want to do is we want to be able to parse information. In other words, if you're a stock trader and it's earnings season, okay, well, maybe earnings, of certain companies are indeed important to you. So you want to definitely parse that data, all right, in order to make decisions. Okay, news events or opinions, very low on the list. Although news can certainly affect price, they're too random of events. Okay, you can't really have a measurable approach to trading news. Okay. So what we need to do is we need to develop some sort of a technique that filters the information. Relevant information is what you need, all right, to make specific decisions day to day, and especially in a very dynamic environment. Okay, and information that you receive that is not worthy of you making a valid, and mindful decision, get rid of it. You don't need it. Okay. So this decision process that we're talking about develops an endless loop, all right, continually repeating itself over and over and over and over again, all right? So what we have done is we have adapted a particular decision matrix called the OODA loop, OODA loop decision matrix. Now, what this simply stands for is observation, orientation, decision, action, and we'll go into details of those. But simply an observation, looking at our charts, right? It's the old eyeball analysis, right? So we want to observe, right? What is the market doing? What is the price action doing? Higher highs, higher lows, lower lows, higher highs, those type of things, all right? And then with that, we formulate an orientation. Is the market trending up, down, sideways, and then again, context is critical. Now, these are think about its own loop. Observation orientation, a little circle going on, right? And observation orientation, observation orientation, observation orientation. So its own little loop. And then when it reaches a certain point in that looping process where an opportunity is presented to us, i.e. one of our trade setups that pops up on our screens, on the Scanalyzer dashboard or on our charts, now we want to get into, okay, the decision process. All right, do we want to go long or short? Well, that's going to be based upon our orientation. All right, what's the entry price will it be? What's the stop? What's the position size? Okay, so with our new tool that we've just recently distributed to everybody, now this gives us some automated information about entry price, stop, exit, position size. So we've helped automate that to a degree to help that decision part of the cycle, okay, be easier for us. And then but we still need to go through a qualification process. So when a signal comes up on the screen, it is valid from a quantitative algorithmic mathematical standpoint. We have to qualify it. So we still need to put some input. It's not automatic. The computer's not going to execute the order or evaluate the setup for us. We have to do it ourselves. So in the action cycle, all right, we're going to take the appropriate action necessary. Do we take the trade? Do we not take the trade? Based upon some sort of feedback loop, okay? And the feedback loop we're going to be talking about is if, then, else statements. And those are very similar to what computer algorithms do. And then once this process, and again, it's kind of a wash, rinse, repeat, doing it all over again throughout the course of the day. All right. So a little bit of background about the OTA loop. It was developed by Colonel John Boyd. His nickname was 42nd Boyd during the Korean War. And simply you can read there what it says, but the looping concept referred to is the ability to possessed by fighter pilots that allowed them to succeed in battle, all right, in a dogfight. So simply the premise of the model is the decision making is that the result of rational behavior in which problems are viewed in a cycle formation, all right. And so to give you more of a visual example of what Colonel Boyd did, if you visualize, two fighter jets, and in terms of the positioning, Colonel Boyd was in the jet up ahead, which is referred to as the defender jet. And then the one behind, which is on the tail of the jet, is referred to as the aggressor. And so they start going through the dogfight, all right, and so forth. And Colonel Boyd challenged all the best fighter pilots of the day that he said, within 40 seconds, I will gain the advantage, meaning that I will reverse the position and I will become the aggressor and you will become the defender and shoot you down within 40 seconds. Well, you can imagine that all the the testosterone is going around in the briefing room of the fighter pilots, and they were putting $100 bills down on that one, figuring that there's no way he's going to be able to accomplish that. But yet the history goes is he's never lost a dogfight, and he won every single one of his challenges. Okay, so he simply mopped up the floor, if you will. So what we've done here is we've taken that concept and applied it to trading. All right, it's very effective. Our traders have been using it for quite some time, and they are making very positive strides with it. So let's go a little bit deeper about this. So the observation part, so simply we want to scan our environment, okay, and which in our case it's the market action. We want to continue to gather information. All right, it's an ever flowing sea or river of information. So we want to capture that. What does the market do? What are the key levels? All right, are we forming trending patterns or sideways patterns and those things. Okay, so what we have to do is, our mind creates images. Right, we know what a higher high and a lower low looks like. Those type of images, various patterns that come to mind. All right, throughout. So our mind is synthesizing this data constantly, and as more information comes to you, your mind is constantly reforming it. All right, so it's simply doing is taking the new images, all right, taking useful images, okay, that it's needed, the relevant information, and then taking everything else that's not needed and getting rid of it. So it's constructing or creating new images and destructing the old images that are useless. Okay, only keeping the ones that are useful. And that's another way of saying we want to stay in the now moment. Okay, many trading psychologists have coined that phrase: stay in the now, get in the zone, those type of things. But the only way is, you need to be what the current action is in evaluating and watching what's going on. Okay. So another thing, we imply that reason some people cannot make good decisions is that people are bad decision makers. It's not so much that they're bad decision makers. All right, is that the information that they're processing in order to make a decision is not the proper information that they need to make the decision that they want to make, that they're looking to make. They're just bad information. All right, so garbage in, garbage out. If you're not getting the correct information that is useful to you, then that information is useless to you, and so ultimately you end up making poor decisions just for the sake of making a decision. All right, just to make a decision, you're making a poor one. Some people would rather make a poor decision just to make a decision, and our viewpoint is I'd rather make no decision, all right, if it's not a decision that it's going to help me in my trading to bring us to the next level. All right, so there's also a saying out there that, and many of you have probably heard it, is trade what you see, not what you think. Well, my problem with that is that if you don't know what you're looking for, how do you know that what you're looking at? So if you don't know what you're looking for and you're staring at the screen, and so they say trade what you see. Well, what do you see? Well, I don't know. I see a bunch of squiggly lines. All right, nothing really makes sense to me. All right, so a lot of people do that. They go through trading and they think they see something, okay, but they don't really see it because they don't really have a core defined pattern in mind of what they're looking for. So they trade by the seat of their pants. Oh, I think the market's going to go up, or I think the market's going to go down, and sure enough, they make the wrong decision because they're not, basing it on valid, relevant information. They're just, grabbing something out of the ether. What I would like to say for our traders is that trade what you know, verify what you see. Meaning that our decisions are based upon a certain level of knowledge of patterns, of repeatable patterns, structures that we know and we understand what they mean, and then it helps us make more relevant decisions. Okay, and then when we see those, we again go through a qualification process through our setups, and then we trade what we see, verify what we see, and then when it's verified, we'll take the trade. All right. So the decision, there's a various processes through the decision where we have these if-then-else statements. All right, and again we have to select the subsequent course of action through our trade setup. So take a look at that in just a moment. And then finally, the action cycle of it, again, as we mentioned, is we just simply have to carry out the decision. All right, execute it, pull the trigger. Okay. And so the benefit of this OODA loop, once you start thinking about this, it's a very slow process, to practice this. And we'll show you some examples in the next slide and two, and then we'll get to some charts. Is that you have to learn how to observe. What is it that you're looking for? Again, throughout the course of the trading session, you'll hear me comment commentate, and you'll also hear me actually see my charts and chat about comments about what I'm looking at, what I'm seeing, and so hopefully you're seeing through my eyes, my observation, my orientation to help you, understand what's going on at the time. Okay, so I'm constantly doing a lot of the observation and orientation for the group, and by way of example, and then hopefully in turn, you now learn to, be able to emulate that and start doing that more on your own, all right, when I'm not there, or if I'm off the desk or something. And then the decision action cycle, again, we have the Scanalyzer to help give us some trade setups, okay? And then the action cycle is again, we got to go through that evaluation process, okay? So it's very structured in how we approach taking trade setups, okay? Nothing is random in what we do. So now in the next slide, let's take a detailed look at the decision cycle. All right, so we already know about the orientation and the observation aspect of it. Let's get a little bit closer. Now, don't get too lost in some of the so-called mathematics here, because it's not really that necessary to truly understand the mathematics per se. Just have an idea, just follow, conceptually along with us what we're talking about. Okay, it's not necessary to understand the deep math. We'll actually see visuals of what I'm speaking of. But what we want to do in the decision and action cycle is that we want to think in terms of probabilities, so we need to think like a computer. So we need to have some understanding of, how these algorithms are produced. Now, algorithms are multi-dimensional, multifunctional. They are enormously complex. All right, but don't let any of that scare you. The bottom line, an algorithm is nothing more than a set of instructions to do something. Okay, think about a flow chart. Right, many of you, know what a flow chart looks like. Well, really, a flow chart is nothing more than an algorithm on paper outlining what it's going to do when it asks certain, questions, and certain conditional statements are true or false. All right, so and then once it, answers a question, it goes on to the next one, and then that's what's called a subroutine. Okay, so simply all these sets of instructions are all a bunch of conditional statements. And again, as I mentioned, they can either be very simple or complex. Okay, so now an example of that would be a simple statement that says, if this, then that, or else. Okay, so in other words, we could say in the mathematics end of it, and again, a proof in mathematics is that if P is true, then Q must be true. Okay, so if P is true, then Q must be true. In other words, mind your P's and Q's. So the direct proofs of the conditional statements. Okay, and again, don't get lost in this. This is just an outline of this. So, all right, so that if P is true, forces Q to be true as well. Okay, so that's an absolute. All right, in terms of, every time P is true, then Q must be true. Okay, so one of the critical parts is that we have to keep straight that what is assumed stuff we can as though it were a fact, okay, and what must be shown to prove it. Okay, so in other words, trending action is an example here. Okay, so if we have a higher high and a higher low, and that higher low makes yet another higher high and another higher low, and that continues. So if P is true, then Q is true, all right, then you have a trend. So that trend is in effect until something changes. Okay, does that make some sense to anybody? Okay, so we want to continue to be just moving in that direction. Okay. Okay, so Lane says yes. Okay, good. All right, so Once you've observed price action and orientated yourself to the correct side of the market, bullish, bearish, whatever it may be, all right, now we move on to the decision action cycle. And now we're going to use this if then and else statement, all right, in helping us plan that logical course of action. All right. And by the way, many of you experience fear, hesitation, uncertainty. All those things kind of build up, when taking a trade. All right. You're always thinking about, well, is it going to work or is it not going to work? All those type of thoughts that occur in our minds prior to a trade are not helpful. All right. They're not relevant to the situation. If you start thinking in terms of the process of trading, and this is what we're talking about here, we're getting more detailed into the process of trading. If you focus on the process of trading rather than worrying about whether or not you're gonna lose any money or if it's gonna make any money, which many of us do, all right, and again, we're all guilty of it at some point. Rather think about the process and saying, okay, well, is this trade opportunity valid or not? All right, so well, how do you know? Well, you're going to guess at it, or you're going to go through a process to evaluate it. All right, so let's go through the process to evaluate it. So one of the examples is, again, using these if-then-else statements. All right, so here's just an example. If price makes a new swing high, what are you going to do? Then I'm going to buy a pivot pullback. If price does not make a new higher low pivot, then do something else, stand aside, reassess. Okay, so again, if it makes a new swing high, then I want to buy a pullback with a pivot. But if it doesn't make a pivot on a pullback, all right, remember how we talked about we use right side pivot rule? So on a pullback, we're looking to buy it on at a specific price point we have in mind. But when the price gets to that level, if it doesn't produce a higher pivot or it doesn't pivot at all, we're not going to buy it. So then we have to, if then else again. All right, so kind of the process continues. So again, in step 2, if price does not make the new swing high, all right, then we're going to assume that the price may test the lower pivot zone. All right, and we'll repeat that process. So again, it's a process of of evaluating, reevaluating, evaluating, reevaluating. Again, that looping process that we've talked about. All right. And then an example number 3, and again, we'll look at visuals on this in a moment. All right. So if price holds a lower pivot zone, all right, then look for the price to make a new swing high. We used to call that a smart bar. Okay. We don't usually use that term anymore. But if there is a new swing high, then we want to buy a pivot pullback. What happens when on the pullback we get a higher low pivot? What's the expected outcome? The expected outcome then would be for price to go on and make yet a new higher high. You see what I'm saying? Okay? So then if the condition of P is true, and P would be in this case if price pulls back and makes a higher low pivot. If that condition is true, then the expectation is that Q, meaning making a new swing high, all right, is expected to be true. It's not an automatic, but it's expected to be true. Okay? Let me know if you're not following along with that thinking. It'll be a little bit clearer here in the next slide. So let's take a look at these examples yet again. All right, but visually. So on the if-then-else statements here, we're going to take a look at the first example. So again, if price makes a new swing high, and you'll see here it makes a new swing high, we want to buy a pullback pivot. Okay? So we want to look for that pullback. So then we go on to say if price does not make a higher low pivot, that means price pulls back and then it continues in this red arrow direction. Okay, right? Then we're going to stand aside, or else we're going to do something else. We're going to reevaluate. All right, follow me so far? Everybody in line with this? This is an evaluation process we do multiple times, throughout the day. So on the other hand, if price makes a new swing high, pulls back, and makes a higher low pivot, it stops and pivots back up, we're going to buy that, and we're going to put our stop below that low, and we're going to assume the expected outcome, Q, will be a higher high. All right? Example 2, visually. Price does not make a new swing high, so we're in a kind of a trading range, slugging it back and forth. All right, and a lot of traders like to buy before it breaks out. Well, if price hasn't proven that it can break out with enough energy, then you may be buying at the top part of a range where other professionals are probably looking to sell at. All right, and you could end up having unnecessary losses. So in this case, price doesn't make a new swing high. So what's the expectation if it doesn't break out, in a sense? Well, the expected outcome, all right, if there's no energy in that move to break out, like in the first example, more than likely you're going to come down and test the lower zone. And again, this is more of a trading range type example. At some point, the balance will change, okay, and what you may see here, like this case, all right. So in the third example, we had a similar trading range ongoing. Prices will kind of back and forth, back and forth, back and forth. At some point, the energy changes. Price then breaks out and makes a new swing high, pulls back, makes a new higher pivot low on a pullback. And what's the expected outcome? Higher high. Does that make sense to everybody? Now, these are kind of like perfect examples. All right, but they are very relevant examples, and we're going to look at some charts here. All right, so these charts were taken quite some time ago, a few years ago, but they're very, very relevant. All right, and so again, you'll see how we go through the process of evaluation. All right, again, so if price does not make us higher high than the expected retest of a lower pivot, if price breaks out, all right, then we're going to sell on a pullback. The expected outcome will be for lower lows. So the idea simply is, all right, if we make a higher high NSH, new swing high, all right, and then price pulls back and then makes a higher low. All right, we actually have a tool in our software that highlights higher highs and higher lows in a sequence. So it helps you visualize what it looks like here. So if price makes a new swing high, pulls back, does not break the low, makes a higher low, pivots, okay, then we want to use right side pivot rule, and the expected outcome will be yet a new swing high. Again, the sequence continues. If a new swing high, pullback, makes a higher low, all right, higher pivot pullback, then we're going to expect yet what? A yet higher swing high. All right, so that sequence, this is again just an example. We'll get to our charts themselves, with our setups. But again, understand the process. If this, then that. If this, then that. Okay, so this is a fairly simple example. All right, so now in the case like this, again, these are some older charts, but they're very relevant. Price was in a consolidation formation here. Okay, and it was bouncing back and forth. New swing high, pulls back, bounce back up, pull back again, held. So the question is, if price made a new swing high, we're going to expect ultimately higher highs. We're going to look for a pullback, and on pullback to A, it held. B didn't break out. Back to C, okay, held A again, roughly on a closing basis, and then repivoted again. So if we made a new swing high, and it's consolidating in a sideways pattern here, the expectation is we will get a break somewhere. All right, but if it doesn't and it breaks down, then if you were looking to buy, you would not buy. Okay, so then here, if if P pivots, okay, and then P is greater than the prior high, so which is the highs here. So if P pivots down here at C, okay, and moves up, and then again, these statements can be fairly lengthy, all right, because they're asking for its condition. If condition of price holds on a pullback and then comes up and pivots, and the price now becomes greater than the prior high here, right, that becomes then a buy trigger. All right, so you can then buy it on these candles, these two candles right here. So in other words, what this simply means in layman's terms, you take out a prior high, it's a buy signal. All right, in a formation like this where we got to move and it's consolidating, buyers are coming back in, takes out the high, that's essentially what we're saying. That becomes a trigger to buy. Okay? Does everybody kind of follow along with that so far? All right, so let's go to the, let me just stop the projection for a second, and I'm going to move on to some of the charts from today. Okay, so on this next chart panel, this is taken from today's trade, and again, we're going to, simply go through that process of assessing if then else, the OODA loop, okay, decision process. So first thing we want to consider is, through our observation, okay, what is it that we're looking at? We're seeing a condition where price is in a lower low, lower high configuration, okay? We see the condition where our fair value zone, all right, the 34 is underneath the 89 and declining. This was earlier in the day, all right, mid-morning. We have the 233 EMA, all right, larger picture, all right, also declining. And we have our ATRs, our average two-range stop structure lines. You can see them here, 1500, 4500, and then the yellow one is our 750. So at this point right in here, all right, this point right in here, okay, what is the market telling us? Well, the market telling us, man, it's pretty weak. Okay, price is below the key fair value zone, and it's sloping down. So we have simply a potential for lower prices to come. Okay, that's our observation orientation. Okay, so that is, this can occur fairly quickly. You ask a few questions. Where is price relative to ATR lines? All right. Where are the ATR lines relative to the next ATR line? Where is the price relative to the fair value zone? Is the fair value zone sloping up, down, sideways? Okay, where's the 233 EMA? All right, that may be relevant in the process. Where is price relative to the midpoint of the session or to the volume trend, which is also referred to as the VWAP? Where is price relative to those key markers? Okay, early in the morning during the opening range, right? We see where is price relative to the opening range rotation midpoint. We speak of that every day, highlight that. We want to make sure, where is price, above it, below it? What is price doing relative to it? Because again, these are all questions that help us with the orientation of price. All right, there's no guessing here. All right, we're not figuring out, oh, the market's going to go up today or the market's going to go down today. No, I don't know what the market's going to do. I'm assessing what the market is doing. There's a big difference. Once we know what the market is doing in the current assessment, we can then proceed to make some inferences or assumptions of what the price is more likely to do given the current circumstances of the condition. Does that make sense? All right. Once we have that, all right, we can then align ourselves to what the market is more likely to do. So in a case of today, it was more likely to move lower, so we were simply staying off the buy side. Okay, we only wanted to be on the sell side. So by staying off the buy side, all right, we have to then wait for an opportunity for our methodology to provide us with an appropriate signal, all right, to enter a trade in alignment with the current conditions. Okay, that could be a bull bear stacker. That could be a premium discount. All right, we have to be patient and wait for that. So today, of course, all right, it was pretty heavy to the downside action. All right, and you can see here was the break. We were talking about the 78s as an important level, and 78s, as you can see here, gave way, and price, of course, proceeded to break sharply lower. Okay, and so now as prices continue to move downward, we're looking for opportunities here to take shorts. All right, so in terms of taking shorts, we want to look for an opportunity where we get a premium signal. So as prices are moving back up here closer to a declining ATR line, 34 EMA, and we know that the structure lines here are negative, okay, bounces here, we're looking for opportunities to short. So what we're going into the decision action cycle. So what we want to say in terms of asking the if then else statement is that if price bounces up and then stalls or stops at or near the 34 EMA structure line and or the CCI comes above the plus 100 line, okay, see how it's a little bit of a complex, question answer here, or condition. But if those conditions are true, I'm looking to sell a premium condition, and if I get a signal, as this provided us for us here, I will sell one at the market, or I will place a sell stop, all right, using the right side pivot rule, slightly below the the prior few bars. Okay, so you find a location, okay, where you're going to place a sell stop, okay, below the current price. You can either sell the market price and then add, if you wish, at a lower price, or you can place a sell stop. So notice what we're doing. If this, then that. I'm already looking, and I want it, and I'm looking for it, and I know I want to be looking for a premium. What are the conditions for the premium? I need to know those in advance. That's part of the knowledge base. Okay? Once we have that knowledge base for us, we can say then, okay, when this condition is true. So when P is true, then I know Q is more likely the outcome. So in this case, what is P? If price pulls back, okay, to a level where it provides a premium signal, I'm going to short them, then I'm going to short them, and the more likely outcome is what? Price then proceeding to go lower, okay? Price proceeding to go lower for the outcome of Q. Okay? Now, same thing here, all right? Okay, and so this will continue. So price will go lower, all right? And then we get another bounce, and the looping process begins again, okay? So if on the retracement bounce, right, price comes back to, again, the ATR line, and the CCI signal gives us a plus above the premium, we know that the conditions still exist for a downtrending directional move. We're looking for a bounce within the context of a downtrend, and simply when that signal fires, okay, or we can anticipate when that signal is going to fire because we can watch the CCI indicator above us and say, okay, it's above plus 100. Hey, I know this is going to hook back down, in a moment or two. which is going to provide me a signal on the chart. So I better plan on placing a sell stop below the roughly the current price points if I'm looking to take that trade. Okay, once we take that trade, your stop's going to be above the high, and again, our automatic position sizer tool will give us the entry, it'll give us the stop, it'll give us a position size, it'll give us a risk-free level and 3 additional T3 targets, in this case to the downside, to be shooting for profitability. All right, so our tools will give us this. What we need to do, again, the computer will generate these signals. Our job is not to figure out where the signal is going to happen and worry about whether or not we're going to win or lose on the next trade, but rather focus on the process, the decision process. Okay, one of the big things that I've promised our members as part of one of my mission goals is to help everyone become better decision makers and to provide professional tools to help us become better decision makers. Okay? This is this process of using the OODA loop. If you focus on the conditions in the parts of the OODA loop, all right, effectively, then, and notice what I'm saying, if you focus on the process of the OODA loop effectively, then, so I'm even using if-then statements qualitatively, all right, so if you do that, then that is going to increase your likelihood of positive trade outcomes, number one. Number two, it's going to help eliminate some of the fear that we all have prior to a trade of worrying about whether or not the trade is going to work or not, right? We don't know whether the trade is going to work or not. Focus on the structure, focus on the process, focus on the setups, and then when the computer generates a signal for us, focus on executing that signal, all right, as effectively as possible. Okay? Don't worry about whether or not it's going to work or not. We don't know. Remember, at the outset of the presentation, we discussed that each individual setup here, each individual of these setups are statistically independent. All right? If you win or lose on this one over here on the left, does not mean you're going to win or lose the same, all right, on the next one, all right, or the next one, or the next one, or the next one, all right. What it does mean, though, is collectively, if you have an edge, if the signals and the method provide an edge, right, just like the casino, you must take every single trade that is valid and qualifies, okay? So trade what we know, verify what we see. Verify the trade setup. What is it that's happening here? All right? You can see this one over here, this red arrow, that one did not trigger, did it? Okay, so it was valid, but it didn't trigger. Prices went up a little bit more, we got another opportunity. Did this one trigger? Yes, this one triggered. Okay, so this one would have triggered slightly below, somewhere around here perhaps, all right? And did it pay as well as these individually on that? No, okay? But it was valid nonetheless, and we should take it. Did it get stopped out? I don't think it got stopped out, all right? But even if you had gotten stopped out, guess what you got? You got another one, all right? And so now the question becomes, what are you going to do with this one? Well, if you're going to play like the casino, what does the casino do when they get 17 in blackjack? They have to hit on it. They win, lose, or draw. They have to hit on 17. So what are you going to do as a trader when you get a valid premium or discount? All right, that's valid. It's in direction. Everything qualifies, quantifies, and qualifies. What are you going to do? Okay, you're going to sit there and say, well, I'm not sure if this one's going to work. Okay, no, you have to take it. So how are you going to take it? Okay, well, again, if you have a certain way of entering the trade, take the right side pivot rule. Okay, all right. This is what we're saying in terms of using the OODA loop, observation orientation, which we do throughout the day. When we get a signal, now this is the critical part. All right. Again, all parts are critical, but this is really this is where the rubber meets the road. All right. When you get a signal, you cannot subjectively say, well, I don't think that one's going to work. You have to go through an objective qualifying process. And if the OODA loop guys worked for Colonel John Boyd and he never lost the dogfight, and think about that for a moment, right? His life is on the line. Our lives are not on the line. Our so-called financial lives sometimes, we think is on the line, but it's really truly not. But if he was able to be successful using this method, okay, or this technique, all right, then we should think very closely of doing the same, right, and using it as well. And that's what we have done with this particular method, all right, is to adapt what he has done and simply apply it to trading. And it works very well. All right, many of our members are using this, and they're having very good success with this. Okay. So in terms of summary, to sum this all up, is again just as by way of review. So thinking in probabilities here requires the trader to accept a belief that random outcomes give an unequal distribution of wins and losses. In other words, you could have 5 wins in a row, 6 wins in a row, 2 wins in a row, then 5 losses. Again, all right, any combination, or just simply a random distribution. That's the concept, all right? But that can actually produce consistent, predictable outcomes, positive outcomes, provided that the methodology has a positive expectancy. Simply what that means is that the has a greater odds that the number and magnitude of wins, even primarily the magnitude of wins is really what it's about. The magnitude of wins, all right, is larger over the losses over a large series of trades. So if you're only taking 1 or 2 trades a day, and the market provides us an opportunity to take many, many more, then you're not executing a methodology to its greatest advantage. Okay, the only way to really get the expectancies out of this method or any other method, all right, to where they're acceptable and that you have real good probability outcomes and a good expectancy, is, guys, you got to take every trade. You got to take every valid trade. Okay, you got to take every valid trade. If it was a computer, the computer would take every valid trade, and it would say, okay, through 100 trades or 500 trades sample size, of that we had a certain amount of losses, okay, and let's just say the losses were 20%. So we had 20% losses, but we had 80% winners. So 80-20 is pretty good. But of the 80% winners, okay, the average win was 3 times. The average win was 2 times on average. Okay, do you think that's a winning strategy? All right, it certainly is. All right, there are other methods out there that they don't have to win 80% of the time. Okay, there are others out there, very good systems that are actually 40% winners, 45% winners. And you could say, geez, why does a 45% winning strategy be a successful strategy? Because the magnitude of the wins, when it does win, probably is 3 to 4 times greater than when it loses. Okay? So, a lot of people go for the high win-loss ratio. It doesn't have to be that. It means that you have to, the magnitude of your wins must be greater than the average loss. Okay? Again, as you've all experienced as members, all right, and as currently some guest members, you've been seeing that many of our trades, all right, produce 2 times, 3 times our initial risks on many of these trades. Right? And in some instances, depending on how it's managed, even more. But the important part is, you have to take every single one of these trades when they're valid. Utilizing, the OODA loop, all right, as we discussed here, keeps you focused on the relevant information necessary, right, to make more knowledgeable decisions. It keeps the fear away. Okay? And again, each trade is a unique event, but collectively, right, they form patterns, and this is what the, casinos and professional traders out there and professional gamblers even out there know. Everybody else becomes, a true gambler, but we're speculators and of direction, and we trade probability. So simply, we become probability traders. Okay, we're not, Wild West traders. So since the computers are programmed to identify and exploit probabilistic trade opportunities, all right. So each of us, if we develop the thinking skills that we've discussed here, that will aid in identifying specific opportunities as well, based upon a given methodology. So again, if this, then that, premiums, discounts, bull bear stackers, everything that we have put forth with our methodology, all right, has been tested, battle tested, and continues to on a daily basis. But again, we want to stay in the now moment. All right, we don't want to be reading or paying attention to other media out there, because guys, the people over on Stock Twits or somebody blogging or tweeting about something, they are not going to help you make a decision to become a profitable trader where you want to begin. It is irrelevant information. They may have fun information that you want to read, and explore. Do so after trading hours. But during trading hours, focus on the information that's going to get you where you want to go. All right? And ask yourself, am I focusing on the information needed for me to succeed? And if you follow this OODA loop decision matrix that we've outlined here, it is going, and practice it. And again, you'll need to practice. It will help you achieve, your goals. It will help. It's a tool. Okay. If it helped Colonel John Boyd, it's going to help Polaris traders as well. All right. So make sure we ask the correct questions of relevant data. Okay, and so by way of references, as we end the presentation here, some of the references where I've gotten in these are good reading. They are listed in the website, but of course Mark Douglas is very popular. Dr. Brett Steenbarger is very good. Many of you know Van Tharp. Okay, very good resources to think, to enhance your own performance. Again, Dr. Brett has some great books. Again, I highly recommend everybody check out these particular publications. All right. So this is going to end the presentation for today in Thinking in Probabilities. I hope it has been enlightening to you. Again, we do speak of this daily. All right, and practice it, think about it, and focus your attention on relevant information. That will all be aidful in your quest to become a successful trader. All right. So thanks very much for this presentation, everyone. I hope you enjoyed it.